Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. I'm really excited for you to hear this show. It's one of my favorites. I enjoyed this conversation so much, and I can't wait for you to hear my talk with Luis Belmonte, a veteran of the game and also a veteran of the U.S. Navy. He's been around real estate his whole life, and you're going to hear all about it. He was around before the internet, as was I. We're going to talk about getting rich slowly by investing in real estate, because that's one of his two books, and this guy has done it all. Can't wait for you to hear this episode right now. This is episode 287 of Zen and the Art of Real Estate Investing with my guest, Luis Belmonte. Luis is a founding partner of Seven Hills Properties. Previously, he was executive vice president and among the founders of AMB Property Corporation, which is now Prologis. He ran the development program and supervised management of assets in the Western United States. Luis, welcome to the show.
Thank you. Happy to be here.
Yeah, I'm excited to talk to you and get your experience. And I know this, so I want to start there with you. What was real estate like before the internet? Because I found it to be a little bit different. I feel like things have changed a lot, at least from how I grew up with my dad looking at properties and not being able to see them all online.
Well, the obvious difference is that you had to absolutely walk and talk and put your hand on it because you couldn't see it online. You couldn't see it on Google Earth. I think the biggest turning point was the invention of the personal computer, which allowed people to run IRRs and sensitivity analysis, and that cut profit margins dramatically. You know, when you were working the back of the napkin and doing it by hand on a 14-column spreadsheet, you didn't do a sensitivity analysis. And when I was first doing deals, I bought little apartment buildings in San Francisco, and my criterion was that once I did my lipstick on the pig, cleanup, paint, carpet, appliances, I had to be generating enough cash flow to buy the next deal in 2 years. So, and we had a concept called spendable, and that was the amount of money that ended up in your hand after everything was said and done, and you'd set aside a little for capital improvements. And all of those things went away, and we started doing IRR, which in my view is a wild-ass guess because the two variables that you have in the IRR, which is the growth rate and the exit cap, are complete guesswork. And we've turned something that's supposed to be a great precision, and we've completely buffaloed ourselves because I've never seen an IRR analysis that showed a loss. And so we have sold our soul to technology, and as a result, a lot of dumb deals got done. But that's just the old geezer talking.
Well, I mean, I'm with you. I agree with you. And I think it's interesting because, when we used to have like a columned graph paper and then you put the spreadsheets into there, your calculations could always be wrong, but you weren't expecting them to be exact at the time. You were kind of just trying to get estimates. Now it's funny because it looks exact, but as you were just saying, everything's really just a projection. You know,
Absolutely.
And if you're dealing with an inexperienced operator, their projection could be based on things that are in a tiny part of the spreadsheet that you don't see. But if it goes down, 2% in one part, that could change the entire dynamic of the deal.
Absolutely. Well, my view is that you should do a napkin deal and an IRR. And if the two of them are close to each other, you're probably okay. If there is a discrepancy, then you better redo both until they agree with each other. So, the IRR analysis can be useful. The only caveat I would say is that the judgment about the risk reward ratio cannot be put down on a spreadsheet. So when I look at a deal, I try and say how much risk, how much work, and is the rate of return I'm going to achieve proper for the amount of risk and the amount of work that I got to put into this deal to generate it. And so, the tougher the deal, the higher the return should be.
Yeah, and really, like, the prerequisite for being able to do the napkin math for a deal is having enough reps in the field to know what you're even putting on the napkin.
Well, it's all about scars. When you look at a deal, what scar is hurting? So, if you're doing a rehab deal, you need to add 50% in 6 months, because once you open the walls up, you're going to find things that you can't test for and didn't expect.
Yeah, and that can't be quantified in the best case scenario spreadsheet, which is always, if everything goes perfect, this is what you're going to make. That's how they get a 20% IRR. But then they do one thing, like you said, oh, actually, all the electric is old, so now we need to rip out the walls in every unit of 100 units.
Well, the other thing about the IRR is, and Wall Street is especially good at this, is timing of dollars invested and very heavy leverage. So when Goldman Sachs says, they're going to be your partner in a deal and they want you to invest, the first thing they do is go out and put as much leverage on the deal as possible, and then they feed their money in and they put your money in last. And then when the flip comes, the time frame is short, and the way to gun the IRR is shorten the time frame. And then they get their bonus based on this IRR that they've generated. And the institution is attempting to invest money for the long term, and they end up investing short term and paying a high fee to do so. So gorilla dust has been thrown all over the deal.
Yeah, and that's a lot of regular syndications now as well, with inexperienced operators who don't have the capital to put in themselves, who are using, taking from Peter to pay Paul quickly, and then hoping that the turnaround is going to be 3 years. But then when rates went up, everyone was like, oh, wait a minute, now we're in trouble. We can't do anything at the 5-year turn.
Yes, absolutely. Well, and this is one of the basic failures of all real estate investment, is a failure to consider what can happen at the projected time of exit. So if rates have gone up, if capital has frozen, if the market has deteriorated, what are you going to do then? So when I was working for an institutional advisor, which was the predecessor of A&B Properties, we had closed-end funds with a 7-year term, but there were 3 1-year automatic extensions at our option, so that you didn't get caught in a tough market when it was time to close the fund. And on the other side, quite often, we closed the funds early, even though we were walking away from fees, because the market was frothy, and so it was a good time to sell at year 4 or year 5, so that's when you sold. And magically enough, when you do that, you establish credibility with the investors, and they want to invest in the next fund. But most advisors are clinging to those fees like some kind of a sea urchin against the pier piling, because they don't want to walk away from the fees.
Yeah, but as you said, though, that's short-term thinking. The long-term thinking is, hey, I want to, especially in the syndication world, I want to keep having repeat customers so I don't have to try out with new people. If you do a good job with people's money, they're just going to put it back into the kitty again the next time, right?
Yes, and that is also your job as a fiduciary, is to represent the interests of your investors ahead of your own interest.
Yeah, I agree. So I was a lawyer, so I mean, fiduciary duty has always been really important to me, and I think it's kind of been lost along the way because it just becomes so modernized in terms of returns. But I think even the people at the top of organizations are forgetting that they owe this fiduciary duty, and their job is to do, on behalf of the shareholders or the limited partners in a deal first. And that's why you sell, like you said, when it's frothy. Hey, we're all going to make out good. Maybe we do a little bit better in a year, but let's get everybody whole plus some, and then get them into another deal.
rest assured, having a great deal of experience in the high-powered world of institutional investing, I can assure you that there are very few true fiduciaries out there. And
Yeah.
for the most part, investment management is a scam, in my view.
Yeah, you mean traditional investment stock management?
Institutional real estate management, you get paid to do deals, so you do deals. And
Yeah.
I am intimately aware of some institutional investment advisors who will go out and overpay for things in order to get the fee. And that's just how life is. People do what they get paid to do, unfortunately.
Yeah, and that makes it harder for people who don't have the experience coming in, trying to figure out who to trust. Well, when you were newer to real estate in the business, how did you figure out who was going to be trustworthy and who wasn't? Because it does take a while, and even when you think you know, you can be wrong.
Well, let's just say I made some mistakes. I got burned a few times. But if you walk and talk to people who have done business with the person you're proposing to do business with, or the institution you're proposing to do business with, and after a while you get a nose for it. You can sense that somebody's interested in properly serving the people who are putting up the money to do the deals, and those who aren't. And interestingly enough, when I started doing deals in Mexico, I had a sidekick with me who spoke Spanish, but we never told anybody he spoke Spanish. So when people were talking to each other in Spanish, they didn't realize that we were eavesdropping, and that helped me on several occasions walk away from prospective partnerships that would have been disastrous if I'd done them. But both my sidekick and I were profoundly cynical. So, when he was listening to the conversations, and everything in Mexico is all about connections and friendships and family. Yeah. So you could kind of get a sense of when people talk to each other, whether they were out to skin the gringo or not. And we actually ended up with a partner who had we were there to build warehouses, and we ended up with a partner who had really no experience in building warehouses, but had great connections with the government and seemed honest. And so that's the partner we chose. And the trade was, I'll teach you how to build warehouses. You teach me how to deal with the government of Mexico. And that was our trade.
Yeah, and that goes back to what you say. I think it's really important for people to note, now people get their first taste of trust sometimes on social media, but that's not real. The best thing is a referral from someone, say, hey, I've invested with these people, or I've worked with these people. It doesn't mean it's going to be perfect, but it's a much better to get a recommendation from somebody that than, a video on Instagram that tells you something great, like a 25% IRR.
Well, the other way, I think, and this gets back to walking and talking and touching the buildings and all that sort of thing. When I was leasing a lot of space all over the country, we'd make an acquisition somewhere where I'd never been, and I'd go in and interview brokers to list our vacant space. And my method of testing things was to talk to other brokers and say, if I don't hire you, who should I hire? But the biggest thing was to take a tour, and I'd say, show me the last 5 deals you've done. And then I could get a sense of whether they had some experience doing the kind of deals that I needed done. And then after a while, of course, you could kind of figure out who the hitters were over the course of a few months, see who was bringing you deals, and you'd figure out who the elite brokers were for your product type and your submarket. But it was a process of trial and error.
Yeah. Let's go through the asset types that you've dealt with over your career, because I know there've been a lot. Did you start in industrial? That's what in Mexico, you were doing industrial?
I started in minor grade multifamily in San Francisco, buying beat-up apartment buildings and upgrading them. And I still own 5 of those deals after almost 60 years.
Yeah.
And so that was the experience. My father was a civil servant because he was driven broke in the Depression, but he always had a side business buying duplexes and rent houses and things like that. So I was familiar with that. And I have a profound mistrust of the stock and bond market, and I'm not the sort of analytical type who is willing to read the footnotes in quarterly reports.
Yeah.
So, real estate, I can put my hands on it, and at heart, I'm an Italian peasant. So, and I have a good feel for real estate, so that's what I defaulted to. And then when I got married, I had a need for regular income because my wife got pregnant, and that's the way we did it in the old days. I realize that's very old-fashioned, but
makes more money for your children.
And I had my criterion in accepting a job was the employer who offered me the highest paycheck, and that turned out to be a dumb decision because the company was wildly over-levered. But I learned a whole lot, and that's when I started in the warehouse business. So I spent 35 years leasing, buying, selling, managing, financing warehouse buildings, initially in Northern California, subsequently all over the United States, and then in Mexico, Japan, Singapore. So at one point, I was one of the biggest developers of warehouse space in the United States. And then when I retired from corporate life, the fields we chose, my partner and I, were neighborhood retail and low-income housing. And the reason for doing that is that those are two product types that work well for smaller investors. And I did not want to report to institutional capital. I wanted to be my own source of capital. So in low-income housing, it's slow. The margins are narrow in the beginning, but you don't have to invest any money except a little front money, which you get back when the construction loan closes. So, and it's layers, it's tax credits, it's boondoggles of all sorts, but you don't put your own money in it. And the rest of it was we merchant built Walgreens drugstores. We built 30 of them. Wow. We built them and sold them, and that's how we built our capital so that, we are truly developers as opposed to indentured servants of institutional money. And we got a few investors in a few deals who are, friends and family, but mostly people who need a place to park 1031 money. So, we're in charge of deals, and kind of my motto is every deal's $100 million, or every deal's $1 million deal. If you do $100 million deal, your share is the last $1 million if it's there. If I do a $5 million deal, it's all mine. So that's kind of our MO now. So we do neighborhood retail, mostly in secondary and tertiary markets, and low-income housing, because there's essentially no marketing risk. So if you build a warehouse and the market cools off, you can sit there for a long time empty. If you build an office building and the market cools, as we now know, it's a complete disaster because not only are there no tenants, if you do get one, you're going to have to spend $150 a foot to put them in. And, it'll take you 7 years of rent to get even on the TIs. So we pick product types that were suitable for small-time developers. So, but I've run high-rise office. The only thing I've never managed is regional malls, but I've managed retail, multifamily, office, warehouse, biotech space, you name it, at one point or another, I've managed it. But mostly I built multifamily and built warehouses.
Yeah, when you were building all those warehouses, especially in different countries, who were they? Who was the intended target to build for? Are these shipping warehouses? Because I think who uses warehouses obviously changed over time. There was no Amazon 30 years ago who could use all of this stuff.
There's always been a need to store product, whether it's sold in a store or whether it's sold online. And the thing that makes a difference with the Amazon era is that it takes 3 square feet of warehouse space to replace 1 square foot of retail space, which is gunned demand for warehouse space. It's also gun demand for warehouse space close in because the online sellers are competing for same-day delivery. That's amped up the space. But the need to store product to match the buying with the manufacturing has always existed. Some of the earliest structures in human history are warehouses. So you go back, 5,000 years, the earliest examples of written communication in the human species are inventory, which was kept by knots on a rope or scratches in a piece of clay. So, the warehouse business, as soon as we climbed down out of the trees, we started counting freight. And so the object of a warehouse, now there's some manufacturing goes on in industrial buildings, but mostly it's storage of product so that you can match the manufacturing with the distribution and the acquisition by the eventual user.
Yeah, and I would think some of that warehouse space now may go to more data centers as they need to increase for AI and all of the power options.
A data center is nothing but a warehouse with no truck doors. And actually, 25, 30 years ago, I was renting space to communications companies that were filling it up with computers. And I actually built a data center in Boston for AT&T like 22 or 23 years ago, which was basically a 2-story warehouse. And it was an adventure because one of the panels came loose and toppled out into the street and squashed the Toyota. So, it was an adventurous deal. But the data center business and our first low-income housing deal in San Francisco, which opened about 30 years ago, our ground floor tenant was Nippon Telephone, which had a data center and this 10,000 feet of office space. So, and a gigantic diesel generator and the first T1 lines and all that stuff. So the data center business isn't brand new. It's just it's just exploded because of the capacity required for AI. But a data center is nothing but a warehouse without truck doors. And the key element in data centers, and my former employer, Prologis, in whose company I own stock, is building data centers. And what they've done is they offer the potential data center user power. So they've contracted for power, and they have 1.3 billion square feet of warehouse space, which has solar panels all over the top of it. And they put in wind turbines and all that stuff and battery capacity. So when somebody comes along and wants a data center, they say, okay, here's the zone dirt and here's the power.
Yeah. That's great. I mean, that's taking care of the main issue that goes together with them both.
It's a damn gold mine for them, and God bless.
Yeah.
As a shareholder, I'm very happy.
Yeah. It's really interesting though, because as you talked about warehouses, we went back to people were just storing things 5,000 years ago. Data centers always existed. What I've always said, because I've been in this, more than 50 years, because I was walking properties as a 2-year-old with my dad, is everything that people are doing now, they don't realize it's all been done before. There's nothing new in real estate, in my opinion. The technology makes it look new. But just as you're saying, all of these things have existed in a little bit of a different form. And I still think you can do real estate the best, more the old school way, which is building relationships, kicking the tires, like you said in the beginning, getting your hands on the buildings, instead of focusing everything on technology and hoping that it's all correct.
Well, if you think all the way back to when I was young and we had party lines, you had somebody sitting in a building plugging things in to get you connected. In effect, that was the data center. So And the same thing with the telegraph. There were people sitting there in a bank receiving the incoming telegraph. So it is about the same. And the second observation I would make is when I was building warehouses around the country and around the world, I didn't go into Atlanta and decide I was going to build a building there. I went to Atlanta and looked at all the industrial developers in town and decided who the most astute and most honest and most well-respected developer was. And then I went to them and said, okay, I'm prepared to partner with you. You bring me a deal. I put up the money. If you build the deal on budget, I give you a 2% fee. If you lease it up on budget, I give you a 2% fee. Then we sell it on paper, and I give you a part of the value you created as a reward for your work. And in the 90s, none of the developers could access any money because of the 86 Tax Act.
Yeah.
So they needed my money, and I needed their local knowledge. The difference between me and most JV people in those days is I was prepared to get into the job shack and finish the job if they screwed it up.
Yeah.
And I made that perfectly plain. And the way we set our partnership up was as soon as you missed your budget, at my option, I could kick you out of the deal. So, but mostly I wasn't picking deals, I was picking partners.
Yeah. Yeah. No, I think that's great advice for everybody.
And those guys are all friends of mine now. I mean, we had good relationship together. We made good business together.
Hey, it's Jonathan. I hope you're enjoying this episode with Luis Belmonte. And if you're not convinced that this guy knows a ton, I can't wait for you to hear the back half of this episode. And if you want to get in touch with Luis and have a conversation with him about real estate like I did, unfiltered, fun, and to the core, a real estate investor through and through, go to 7, that's the number 7, HP.com. It stands for 7 Hills Properties. Go to the contact link. Try to get in touch with Luis. I'm sure he'd love to chat. Let's get back to the show.
I wanted to ask you a question of those first multifamilies that you were buying in San Francisco, and then even going back to what your dad was buying. Because I remember when I started, of course, the MLS there was no online MLS. It was a book and there was no photos. So how did you find the deals when you first started buying? Because it was a while ago and it was a much different way of deal making.
Well, I'll give you 2 examples, one of which has to do with my first exposure to the warehouse business. So, nobody had any idea what the inventory was. So I had some broker friends that I did business with, and there were 3 guys in this little office in the East Bay who flogged industrial space, and they kept their inventory on 5x7 cards. And they would meet on Friday afternoon and drink beer and exchange information on what was available, what the prices were. So I started going to that meeting and bringing the case of beer. And I sat there with my notebook, and as they exchanged data, I would write it all down and then go back to my office and collate it. So I knew who had what for rent and how much it was. Another wonderful example is how I bought buildings in San Francisco. One of my deals was with a brokerage company that actually guaranteed loans for guys like me who had no money. So the typical deal was I put up 10%, the seller carried back 15, and the broker guaranteed a loan with a local S&L for 75%. So if I flopped, he could buy a building for 75 cents on the dollar.
Pretty smart. Yeah.
He was the one who was picking out the deals. Yeah. And since he was the multifamily stud of San Francisco for working class units, when they brought me a deal, it was a deal they wanted to own. So, I had a good sense of that. But my other technique was just a joy. I had what I considered the oldest human being in the world. He was probably 70, but he trolled the obits. And so when somebody died, he would look up and see if they owned any property. And typically the man died before the woman, and the widow was confronted with running property. So we'd go to the widow and say, this is how much I can get you so you won't have to collect rent. And I have someone who will pay you enough to make my commission and the closing costs and leave you a little money. And you will receive a check every month, one check for the equivalent of the rent you were getting now. And those ladies sent me Christmas cards until the day they died. They were so happy to get out of the Haight-Ashbury and the summer of love, and people.
Well, they could have never managed it.
And rent strikes and drug deals and candle making and all that stuff. So I bought 3 buildings in the Haight-Ashbury for good prices, and I sent a check every month to the widows, and they were pig happy. And I went in and threw the deadbeats out and upgraded the units, and I own those deals today.
Yeah, what's the trajectory been like for Haight-Ashbury? Because I've been there. It's obviously a very, very interesting place. It still has that hippie element, but of course, San Francisco is one of the highest value real estate markets in the world. But it's very interesting, like transient type place as well.
Well, it's just above Haight Street. Started out as a very upscale neighborhood, and then during hippiedom, and the closer you get to Haight Street, the more this is true. It went down, and now it's back being one of the most desirable areas in San Francisco. It's got good transportation connections. It's close to the park, and Haight Street is now more of a tourist trap than hippiedom. So, but to show you kind of how things work in the People's Republic of San Francisco with rent control. When I first bought units in the Mission District and in the Haight-Ashbury, my rents were $125 a month. And I would go in and do my rehab and raise the rent to $150 or $175, and I'm pig happy. Those units today, when I've been able to turn them over, and I can't turn all of them over because of rent control,
right.
But the top rent I'm getting in one of the units for which I was charging $125 a month is now $4,150. And that's what rent control has done for San Francisco.
Yeah. What would it be without rent control?
Well, it would be considerably less. I mean, our rents are 2 to 3x. Well, the average rent in the United States, I think, is $1,050 or something like that. So, and one of my deals, which I screwed up completely, we bought a house for $28,000 in the Richmond district to fix it up, and we sold it for $53,000. And today, that house would sell for $1.4 million. Same damn house. That's what our public policy has done for us. And I have ridden that wave, and I'm happy to do it. I mean, if the government wants to create a trough, I'll stick my snout in it, get what I can, and get away before they start blaming the pigs.
Yeah. Is there a big difference between developing in the United States and outside in terms of like government regulations? I know we've had a lot of guests on the show who've developed internationally, and it's really like depends, as you were saying, how well you know it. That's why you got the partner who knew how to get it done in Mexico, I assume.
There's so many things that are different, developing in different cities in the United States. Well, I'll give you a couple of examples.
Yeah.
So I go to New Jersey to do a deal. We bought
That's where I live.
We bought a big building from Revlon on Exit 8A next to the Turnpike.
Yeah.
And I get a local developer who's going to build the addition for me, several 100,000 feet. So he shows.
Is that near Princeton? Is 8A near Princeton?
No, 8A is, I forgot the name of the adjoining town, but anyway, it's 8A, just north of 8A, where Revlon used to be. And so we're going to build a good sized warehouse. So, they say, well, we got to use precast. And I said, precast? What do you mean? Precast is long gone. We're using tilt-up. I mean, I'm using tilt-up all over the world. Oh, no. Nobody will rent a tilt-up building in this location. What? And tilt-up's an extra 50 cents a foot. We're building 400,000 feet, for heaven's sake. No, we got to use precast. And so, magically enough, I take them down the road to where Trammell Crow, a Texas developer, and my big competitor is building. They're building a tilt-up building, which is all pre-leased. Don't tell me you can't, lease a tilt-up building in New Jersey. Give me a break. And then, I go to Mexico, and it turns out there's no title insurance in Mexico. It never occurred to me. So I say to my Mexican partners, how do I know I own this land when I pay the money for it? Well, it turns out I don't know I own the land. So, and the land, I'm buying it from a guy who bought it from an ejido. An ejido was something that came after the Mexican Revolution, where everybody got 11 acres approximately, but you didn't hold fee simple title to it. And you couldn't hypothecate it and all that stuff. So I said, well, how do I know that this works? Well, it turns out the ejido could sell the land, but only if everybody in the ejido agreed to it, and you went through a very elaborate process. So I got a U.S. lawyer and a Mexican lawyer. I said, show me that the process has been properly executed so I know I own the dirt.
Yeah.
So they go to the Hall of Records, there's a roll of plans and nothing else. So we have to start the process from scratch to prove that when I hand over the money, I'm going to own the dirt.
Yeah.
And then we start construction, and I say, who's the testing lab? And so what you do is you test the mud to make sure, and you test the rebar, all that stuff.
Yeah.
There are no testing labs in Mexico. I got to build my own testing lab. I got to build my own. I got to hire my own soils engineer to run all the soils tests because there's no soils engineering firms. So, completely different world. And they build everything by hand. So I get out, I'm building an 800,000-foot building, and it's being built with 5-gallon buckets of concrete, a guy carrying 2 of them to pour in the footings. There's no concrete pump. And my storm drain, I have to build all the way to the river. And so I got 2, and it rains like hell in Mexico City.
Yeah.
I got 2 6-foot in diameter pipes running from my site to the nearest river. And I gotta bring in my own transformer. So, whole new world. And on the other hand, I go to Querétaro, and we're going to build something there, and all the city fathers entertain me, and the guy sitting next to me hands me a card, and he's the Minister of Economic Development and Environmental Protection. I thought, well, now this is a good combination. We might get something done.
Yeah.
And then we do a deal in Mexico City. We buy a big piece of land, 150 acres that's in the floodplain. And I say, where are we going to get the fill to bring this sucker up 3 feet over 150 acres? We bought the adjoining mountain. And move the mountain,
pushed it in,
and then our problem is how we're going to get a connection to the freeway. We got to build our own. So I built an interchange, and I also built a bridge across a river. So you get no infrastructure help from the Mexican government. Yeah. Yes, it's different. And in Japan, we built a very large deal there. And I said to the Japanese partner, well, how are we going to bid this out? They said, well, we don't bid. What do you mean you don't bid? He said, well, you can put the deal out to 4 or 5 contractors, but they'll just get together and decide who the winning bidder is. Oh, I says, how does this work? So I got to hire somebody to give me an estimate to make sure that the bid we take is within reason. But the flip side is there's no change orders. So once you get the bid, they'll build it for that price no matter what. So it's ups and downs. Anyway, overseas, different states, different cities.
Yeah.
In the People's Republic of San Francisco, they got rules, but the rules are meaningless. They're only the opening bid. So then the extortions really start.
Right.
In Oregon, you build, they're just as green as San Francisco, but if you follow the rules, you get a building permit. So, it's different. And when we're building Walgreens drugstores, the first thing we did was go find out in any community we're going to build in where the political juice is. Who's the connected engineer? Who's the connected lawyer? Who's the former mayor that runs a consulting company? Because the politics is everything in coastal America. So every deal it is different, and you're going to pay a stupid tax. So you got to find out where the levers are before you start doing anything.
Yeah, well, I mean, if you look at the theme between all of these things that you said, you're paying less of a stupid tax on everything because you're spending the time to build these relationships and find out who's who, whereas your kind of green investor may come in and just, try to build something without, people who try to, you're not building an office building without talking to the city to know what's there, and then they end up 5 years on a project undone.
You just get slaughtered. I mean, you get localed all to pieces. So the only way to avoid being localed is to make contact with locals who can front for you. And so that when you're walking into the planning commission or the city council, the people standing up are people they know. And so as an example, I'm building a deal in San Francisco, and we're going to hire a land use lawyer because nothing happens in San Francisco without a land use lawyer.
Yeah.
So what I did was we selected a guy tentatively, and then I went to some hearings at the Board of Supervisors where he was, and I watched the body language and interaction between him and the members of the Board of Supervisors. So after he finishes testifying on a deal, he walks up to the dais and starts having a chit chat with everybody there. And so, I figure, okay, this guy, they like him. And he was a very likable human being. And so that's fine. That's my guy.
Yeah, I mean, but this advice is something that even new investors can use now. It's finding out who knows the things and not trying to be kind of, out there on your own. You can't really get too much done in real estate well on your own because as you were saying, you'll pay a 5x stupid tax on that. Why do you think people are scared of getting partners? Maybe because they're scared of getting scammed, or they don't know who to trust, or they don't want to spend the time.
They're greedy.
Oh, yeah. Good point. Yeah.
They don't want to split,
But then they lose twice the money.
I'd rather get half of something than 100% of nothing. So I want a partner. And I explained to my partner, you're going to be my upside partner and my downside partner. So, when I'm hiring a consultant, I say, okay, here's the fee I'll pay you, and then the fee, and then the second half of the fee, or the second 2/3 of the fee, comes if we succeed. So you got skin in this game. And when I'm looking for partners, I say, I'm not looking for an upside partner. I'm looking for an upside and downside partner. So if this thing flops, you're in it too.
Yeah. So I wanted to get your take on this because you've been through several cycles of the economy now. There's people now, of course, freaking out because rates are allegedly high. But over the course of your life, it's nothing, right?
Squat about high.
Right.
I remember when the prime rate was 20.
Yeah. I mean, so we'll speak to them a little bit. I mean, because everything is cyclical, but even if we're sitting at a 7% rate historically, that's still generally average.
Here's the way rates should be. So the risk-free rate is 2.87 or whatever the hell that is. So you look at inflation. Inflation now is in the twos, and you got to get a spread of 2 something to have a real return. So that gets you to 4.5 for the 10-year Treasury, and then you got to have a spread to real estate. So that's got to be 2 or 3, and magically enough, you get a 7% rate, and that is not going to go away. So when the Fed dropped rates 100 basis points, the 10-year Treasury went up.
Yeah.
So all of this business about the Fed lowering rates is all crap. Now, for numerous years, I stood in public venues behind a podium and said, friends, borrow now, borrow fixed, borrow long, money's on sale. Inflation-adjusted interest rates at or near zero are insanity. This will not last. And year after year, I was proved wrong. Finally, I got it right. But my friends at Prologis were out in Europe borrowing 7-year money at 1.3. At one point, my man Hamid Bogadam borrowed 500 million pounds sterling at minus 80 basis points. And I wrote him an email and said, if they're paying you to take the money, why didn't you borrow $1 billion?
Yeah.
I mean, it was insanity. And so in the 80s, I sold a primary residence because we lived out in the fog belt and my wife had a mold allergy. And I invested the money in treasuries, 11.25%. Thank you. And they were paying 15% on CDs as the savings and loan business was imploding.
Yeah.
I sold my mother-in-law's house in Los Angeles and invested the money in a bond fund that was kind of B plus, A minus bonds, 16.25%. Thank you. People think interest rates are high today. They are smoking something. Interest rates are still low. 3 and 4% interest rates generated a whole lot of really stupid deals that are coming home to roost right this minute. And so 4 years ago, I said to my partner, money's on sale. I went and had lunch with my ex-boss. I said, what are you doing? He said, I'm borrowing money. It's on sale. And I said, we need to refinance everything. And we did. and our biggest loan we got from HUD, 274, 35 years. Thank you.
Yeah.
And most of what we were able to do was 7 to 10 years in the fours because we're small time operators. But we do not have a loan rolling over until 2030 something. And I could not be happier. And by the time the rollover comes, it'll be almost a rounding error. We will be in position to pay off the loan balance if rates have skyrocketed. And the first house rehab, the first house flip I did, we got hammered because the rates were at 9.5% when we went to sell the house, and we were trapped. We were truly trapped. And so, anybody that thinks these are high interest rates, nuts, just nuts.
Yeah. If you were going to counsel someone, if someone came to you now and said, "What's the best asset class to create long-term wealth?" What do you think it is based on your experience? You've been in almost all the asset classes.
I would say, number one, what rings your bell? What I don't like office space because it's a taste business, what the boss likes and all that. And I found out I don't belong in the taste business. I belong in the shallow end of the gene pool, be the low-cost producer. My nickname when I was flogging space was Lowball Louie. So, I've always bought working-class apartments. The luxury business is not me. It's not my personality. Yeah. I like warehouse space because it's a whole lot more fun dealing with truckers than office managers. Yeah. And I'd rather deal with a leaking roof than a slow elevator and people having hot flashes and wanting the air conditioning adjusted. So it's where you feel good. And so number one, don't get into the real estate business if you're unwilling to unplug a toilet or stand on the doorstep to collect rent. So go into find out what your personality is all about, and see if you've got some instincts for it. I mean, I can go over a site in a helicopter and tell you what belongs on the site because I've been doing it so many years. Yeah. And I'm seldom wrong because my instincts are well developed. Now, I don't have an instinct for stock. I don't have an instinct for bonds. I don't have an instinct for art, but I have an instinct for real estate. So, some people are good at taste. I have a friend who was the inventor of the food court, who worked for Rouse, built regional malls. I mean, he has a sense of retail that hell won't have. And when I walk around with him, he points out things to me that never occurred to me. And, he developed Santana Row in San Jose, which is kind of cutting edge suburban downtown redevelopment. I mean, he's really good at it. And that's what interests him. So, find something that interests you. The two asset classes I like are multifamily and warehouses because the turnover costs are lower. Turnover costs in retail, especially at the high end, are very high. Turnover costs in office are astronomical. Yeah. So, typically it costs you like somewhere between 50 cents and $1 a square foot to turn over a warehouse space. In apartments, it's carpet and appliances and some paint. Yeah. So for a small-time investor, multifamily is the best because you can always lower the rent. So if you keep your leverage reasonable and the market goes to hell in a handbasket, you can always lower the rent and get a tenant. That's less true in warehouse space. When the market dies, it really dies, especially peripheral. If you're close in and you have smaller unit space, you're probably all right. You can lower the rents and rent to somebody. So I want downside protection. And so those are the asset classes that have downside protection. Neighborhood retail in dense locations also has pretty good downside protection. For the most part, there's always a tenant there at the right rent.
Yeah, I like what you said about multifamily because I feel like it applies to people who want to get in like you started, 2 family, 3 family, 4 family. Maybe they go up into the commercial, they're looking 5 or 8 units. But it's a good note to say, hey, if you really need to, don't let the property sit out there for 6 months just because you're unwilling to go down a couple $100. Just get the consistent rent, and then you'll be happy about it next year.
Here's the wisest thing I can tell you today. In a falling market, the first one that lowers rents is the one who makes out. And that's happened to me. And I've marketed space all over the country, all over the world. When the market starts going sour, if you get there first, then you can get 3-5 year tenant at a rent that doesn't look very good now, but in the future, it will look like a miracle. And those who hold out get hammered. So
Yeah.
when the market gets soggy, get there first.
Yeah. Wow. Fantastic. Really appreciate it. I really loved your insights. I feel like they're really straightforward, but very true and honest to what people can still get benefits from now of how you did it when you started. Is the best place for people to find out more about what Seven Hills does at the number 7hp.com?
Yes, L. Belmonte at 7hp.com. But if you want, what I've learned, I've got some books, Real Estate 101.
Oh, right. Yeah.
Street Dog MBA, Street Dog Negotiator, Street Dog Manager. Real Estate 101 basically does a quick analysis of each product type and what the essentials are and kind of the basics of the investment business. Street Dog MBA is lessons I have learned from things I screwed up or things that happened to me. So tell a story, distill a lesson. Tell a story, distill a lesson. The theme of Street Dog Negotiator is don't worry about winning, worry about getting what you need. So make a list of what you really need and a list of what you want in descending order of importance. If you can get what you need and some of what you want, get up from the table, sign the document, tell the other team what a grand job they did and how they beat your brains out and get the hell out of the room, go on to the next deal. Forget about win-win, forget about win, forget about prestige, always sacrifice dignity for dollars, just get out of the room with what you need. The theme of Street Dog Manager is when you're in charge of something, you are not the boss, you're a servant. If you serve the organization or the team or whatever, then the rewards will come to you, but that comes second, not first. You're the servant, not the manager. So that's kind of the spectrum of the ideas I'm putting out. The books are on Amazon, Kindle, or a paperback. They're cheap. I tried to do Audible with AI, didn't work out all that well, but eventually I'll put them all on Audible. And I ain't making any money selling books, so I price them low.
Yeah. Well, I really appreciate it. I've been enjoying the conversation, and it was great to get you on the show.
Thank you.
All right. That was Luis Belmonte. You can find the company at the number 7hp.com. You can find the Street Dog series and Get Rich Slowly, Invest in Real Estate and Real Estate 101 on Amazon or wherever you buy books. I'm Jonathan Green. We'll see you next episode.
Thanks for sticking around to the end so you can get a preview of who's coming up on episode 288 of Zen and the Art of Real Estate Investing. My guest is Brett Swartz of Capital Gains Tax Solutions. Sometimes when I hear this, I think it's going to be a similar show to other ones that we've done, and that is not the case. You can unlock truly passive income and defer capital gains. Sure, that sounds good, but they've closed over 1,000 deferred sales, trust, and real estate transactions representing billions in assets. But we get into way more than that next episode with Brett.